All right, so good day, everyone. So today I'd like to, excuse me, discuss about the terminologies and, of course, what are those process that we are going to do when we are trying to analyze and record the different transaction on our journal. Okay. So before that, I'd like to ask permission to allow my screen or rather to share my screen with you guys. Ayan. So I think this is visible to you. So this is the subject for fundamentals of accountancy, business and management 2 by yours truly, your subject teacher. I am Mr. John Carl P. Bullo. And for today's agenda, we have the accounts title on the first, and the second will be how are you going to write those figures or even the titles in journal. So, but before that, let me just take a short review with regards to how we are going to identify different accounts title and where does the accounts title would be fitted on. So we do have the five major accounts. We have one for the assets, two for liabilities, three for owner's equity, four for income, and then five for expenses. And these major accounts have its so-called accounts title that we are going to use when we are trying to interpret and record different transactions. Okay, so we do have first, okay, the assets. What are the assets? Actually, guys, assets is divided into two. We have the current asset and non-current assets. But on this slide, we have the first one, the assets. So we have cash as the definition itself. We have is any medium of exchange that a bank will accept at face value. Normally, this is a self-explanatory, guys. Account receivables or claims against debtors, customers, or clients arising from the services rendered on account and the sale of merchandise. That normally, the sale would not be generated on the cash basis, but some of our customers are using the so-called ATM cards for the debit and the credit cards for their account. And of course, they are obliged to pay sooner. So we need to record it that on our company. Next is the note receivable. What is the differentiate between the two? The difference in between, they are all the same. I mean, they're both the same receivables, but therefore, in terms of using the instrument, the so-called a written pledge coming from the customer. But based upon on the meaning here, these are the claims against debtors, customers for the service rendered, evidenced by written promise, which means there is a paper intacted. When was the instrument made and who made the instrument or the paper, the amount indicated on the paper, of course, and the date when will be paid by the customer. So again, a written promise to pay issued by the debtor. And of course, we also have the merchandise inventories. The merchandise inventories are considered as your assets because these are the goods on hand available for sale. Meaning these are the products that has a value and in which the seller maybe sell no, on the current or in the future. Supplies, so it is easy to memorize because supplies is defined as the consumable goods used in the course of business. Prepaid expenses or expenses rather paid in advance. No, so we have prepaid rent, prepaid insurance, once we have experience on our transactions that we have the advance payments, of course, we will consider our accounts as the prepaid, but depending. For example, we have the advance payment for rental, so therefore, we are considering this transaction as the prepaid because of the advance payment, but still, we have the word rentals or rent, so therefore, we have the prepaid rent. Now, let us go on with the non-current assets. This is normally part of the assets that will help on the current course of business. We have the PPE or the so-called property, plant, and equipment. These are tangible assets held by an enterprise for use in the production or supply of goods and service. We also have the equipments are tangible, meaning to say this is what? The things that we can touch. Okay, so tangible assets, which are tools or instruments used in the operations of business. One of the example of the equipment is a so-called computer that may be used through transactions, communications, email, and even a payroll account, no? So we use different office applications by this equipment. Furniture and fixtures are properties owned by the business, which are not part of the building property, but others who sells the building property rather, they do have the free of the furniture and fixture so that it will be added on the figures with regards to the amount, no? So on how much they are going to sell this property with the furniture and fixture. So next is the second part of the major accounts is the liability. We have the accounts payable or the amount due to the creditors for assets acquired to the account. Some other clients are they are purchasing, they are buying different products, but they did not issue money, but they are going to pay with the use of credit cards. No, so therefore the credit cards is considered as the credit, and this is the obliged to pay by the holder itself. Notes payable, again, it's the same thing with the notes receivable, but this is different because payable means obligation to pay, but there are some um, instrument that we are going to sign, not the same with the notes receivable. Salaries payable or unpaid salaries to the employees at the end of the accounting period. So whenever there is a business, the owner itself is minding about the payment of their employees on 15 and then 30th, normally 15 and 30th of the month. Okay, so when employees rendered a service, of course, he or she is what? Obliged to receive the so-called return of service, or the employees must be compensated to whatever service he or she rendered on that day. Tax payable is present obligation to the government. No, once you have been reached the minimum amount, for example, 25,000 a month, then therefore you are subject to tax and you need to pay for it. Otherwise, you are what? Escaping the tax, or you are so-called as the tax evader. Interest payable is the interest incurred on the loan, but they are not yet paid at the end of the period. Okay? So normally, once we are trying to lend money from a individual or a bank, there is a principal, there is a interest, and of course, there is a rate or a number of years that needs to pay for this amount of principal plus the interest. So therefore, obliged also to pay the principal and the interest. For the owner's equity, we can define the owner's equity as the two. The first one, the owner's capital, is the account that represent the equity or the claims of the owner on the assets of the business, or the so-called investment. So all of the company are mandated to have their capital for them to be able to operate the business or in the ordinary course of business. The second thing under the owner's equity, we have the owner's drawing. This is the account charged to the owner's drawing or cash or other assets withdrawn or taken by the owner from the business for personal use. There are money that is different from the owner. Once, for example, I am the owner of business. Once I put up a business, the money the money stand on the business is different from my own or from my personal money. So therefore, I am not allowed to take money coming from the company. Otherwise, this is so-called as a drawings or withdrawals because I've used it for my personal. Okay? Then, the fourth one, we have the income or the revenue na tinatawag natin. We have the sales or the total sales of merchandise sold. These are the products availed by the customers and we record it as the sales. But literally, we have confusions in terms of the sales. How about, sir, those customers who paid using their credit cards? We actually record it to the use of the account receivable, but we can record it as the sales, of course, no? So we could add the cash on hand sales plus the amount or the money that we are going to receive in the future. Professional fee income is an income earned after rendering professional services, such as the CPAs, the doctors, and the lawyers. But take note of that when we are trying to set the professional fee income, this is different. Na? The basis for this are the educational background, the length of service, of course, and some other trainings and seminars that they adapted to. Excuse me. So that is why if you are going to consider or notice, sir, why is it that other doctors have different doctors fee? No? So we you will experience all of those when you are confined with different hospitals. Rent income is the amount of lease or rental earned for the period if you are the seller of the certain business. But if you are the buyer part, then we have the rent expense on this part. But later on, this will be tackled on the next journey of your accounting subject. Service income is the amount of income earned from services rendered from the service concerned business. For example, I have my parlor and therefore I am done with the haircut with my client. So therefore, the money that he or she is about to pay is considered as the income of my company. And that is part of the service I rendered to the client. Interest income is the amount earned for lending money. Okay? So when you lend money, of course, there is a so-called income. The last part of the major